Welcome back to No Free Lunch on Stock Newsroom, your daily U.S. market brief in under 10 minutes. Today in the studio with me, Brian.
Thanks, Lily. Straight to ServiceNow, because this is the stock that set the tone for the whole software tape today. Shares are at $85.73, down 16.82%, after a quarter that was good enough on the numbers, but not good enough for a market obsessed with artificial intelligence disruption and geopolitical risk. ServiceNow said first quarter subscription revenue rose 22% to $3.67 billion, and adjusted earnings came in at 97 cents a share, right in line with expectations. The company also raised its AI annual recurring revenue target and just closed the $7.75 billion Armis deal. But investors are focusing on delayed Middle East closings and a softer second quarter growth path. That combination is hitting the entire enterprise software group.
And that is why the reaction is so harsh. The company did beat on revenue and management still sounds constructive on the long term, but the street is trading the near term, not the 5-year story. Analysts are still mostly positive, yet several price targets came down after the print, which tells you how much caution is baked in. The stock had already been under pressure this year, and today's move pushes it deeper into correction territory. What matters now is whether the market starts to believe that AI is a tailwind for ServiceNow's workflow platform, or whether investors keep treating software as a business model that can be disrupted before the payoff arrives. Thanks, Brian. Next up is Lululemon, and this one is about leadership change colliding with a weak setup. The stock is at $144.39. Down 11.67%, after the company named Heidi O'Neill as its next chief executive, effective September 8. Investors seem to like the resume, but not the timing, because she is not taking over right away, and the company is still dealing with governance pressure from founder Chip Wilson and activist investor Elliott. The quarter itself was actually solid, with earnings of $5.01 a share, and revenue of $3.64 billion, both ahead of estimates. The problem is the outlook. Full-year earnings and revenue guidance both came in below Wall Street's expectations, and that is what the market is punishing today.
Right, and the market is also asking whether this is a brand problem as much as a management problem. O'Neill spent decades at Nike, so she brings real apparel experience, but she is stepping into a company that has lost some momentum in the United States and is facing tougher competition. The stock has already been under heavy pressure over the past year, so today's drop adds to a much bigger reset in investor confidence. The numbers say the business is still growing, but the guidance says growth is not strong enough to justify the old multiple. That is the tension here. Good quarter, softer roadmap, and a CEO transition that may take months to prove itself. Now to Thermo Fisher, where the numbers were strong, but the stock is still acting like investors want more growth. Shares are at $460.53, down 10.4%. Even after the company reported first quarter revenue of $11.01 billion and adjusted earnings of $5.44 a share, both ahead of expectations. Management raised full-year revenue guidance to $47.3 billion to $48.1 billion and lifted adjusted earnings guidance to $24.64 to $25.12. The company also highlighted buybacks, a dividend increase, and new collaborations with NVIDIA and OpenAI, which should support the innovation story. But the market is still focused on slower organic growth, tariff pressure, and whether this is enough to re-rate the shares.
That is the key point. Thermo Fisher is doing a lot of things right operationally, but the stock has been stuck because investors want a cleaner acceleration story. The quarter showed solid execution across life sciences, lab products, and biopharma services, and the Clario acquisition added to revenue and earnings. Still, the market is not rewarding stability the way it used to, especially when the broader healthcare and tools space is looking for faster top-line momentum. So, this is one of those cases where the fundamentals look better than the tape. If management can keep delivering, and the macro backdrop settles down, the setup could improve later in the year. Let's move to Salesforce because this is another software name getting hit by the same fear trade. The stock is at $172.94, down 8.9%, after investors reacted to a softer tone across the enterprise software group. The company is still leaning on its Agentforce AI push, and some commentary points to meaningful revenue potential there. But the market is looking past the long-term story and focusing on the near-term reset in sentiment. Salesforce has also been under pressure from broader concerns that artificial intelligence could change software pricing and reduce the value of traditional subscription models. So even though the business remains huge and profitable, the shares are being treated like a show-me story until growth reaccelerates.
Exactly, and the interesting part is that Salesforce is not really being punished for a bad quarter today. It is being sold because the whole category is under pressure, and investors are asking whether AI helps these platforms or eventually competes with them. That is why the stock can fall even when the company still has a strong installed base and a real enterprise footprint. The market wants proof that the AI products can translate into durable revenue, not just headline. Until then, every software beat is going to be judged against the same question. Is this a temporary slowdown or the start of a structural change in how software gets bought? Finally, Supermicro Computer is getting hit by a very different kind of headline risk. The stock is at $27.33, down 631%, after reports that Oracle canceled an order for 300 to 400 Supermicro server racks loaded with NVIDIA chips. That could mean more than $1 billion in lost sales, even though some racks had already shipped. The company is also dealing with a growing legal cloud, tied to allegations around export control violations and server diversion to China. At the same time, the business still has a real AI server growth story, so this is a classic tug-of-war between fundamentals and controversy. For now, the controversy is winning the tape.
And that is what makes Supermicro so hard to trade right now. On one hand, the company has been one of the biggest beneficiaries of the AI build-out, with explosive server demand and huge reported revenue growth. On the other hand, investors are staring at lawsuits, regulatory questions, and now possible customer loss at Oracle. When a stock has already run hard, bad headlines can hit much harder because there is less cushion. So the market is not just pricing in slower growth, it is also pricing in uncertainty about who the next buyer is, how much margin is left, and whether the legal overhang gets worse before it gets better.
That's today's No Free Lunch. If it helped, leave a like, subscribe, and drop a comment with the ticker you want us to break down tomorrow. For the full story on every headline we covered, head to stocknewsroom.com. Same time, same place tomorrow. Thanks for being here.